Hey everyone, welcome back to Corporate Decoder, the place where we try to make sense of all the corporate jargon so you don't have to. And let me tell you, Roman DBDR Acquisition Corp, the SU, has filed its quarterly report, and boy is it a wild ride of numbers and future plans. Buckle up because we're about to decode it all before we dive in if you love getting straight up in. Sites from these complex financial documents, then make sure you're subscribed. And if you want to chat more about these companies and get live analysis, join our Discord community. Link is in the description below. So what exactly is Roman DBDR Acquisition Corp II? Well, it's a special kind of company called a blank check company or SPAC. This means it's formed with the sole purpose of finding another existing company and merging with it. Basically, it's a company that exists to buy another company. Its goal is to find a target business and combine with it to make it a publicly traded company. Let's jump right into the numbers now. Looking at their balance sheet as of the 30th of September 2025, we see that the company has total assets of around $239 million. This is a pretty significant jump from the 31st of December 2024, when their assets were about $202 million. A big chunk of this increase comes from their investments held in the trust account, which grew from just over $201 million. To almost $239 million, this trust account is basically where they keep the money raised from their initial public offering or IPO waiting to be used for that business combination. On the other side of the balance sheet, liabilities have also gone up significantly from about $301,000 to $275,000. This part of the balance sheet tends to fluctuate quite a bit as companies accrue expenses for ongoing operations and upcoming deals. Now here's where things get interesting. The company has a massive amount of Class A ordinary shares subject to possible redemption. These shares are valued at nearly $239 million. This figure represents the shares that public shareholders might redeem if a business combination isn't completed or if they vote against it. This redemption feature is a key characteristic of SPACs, and it means a large portion of the shareholder. Elder equity has this red line through it effectively, meaning it might go back to the shareholders at some point. Moving on to their income statement for the 3 months ending the 30th of September 2025, they reported a net income of over $21 million. This seems like a lot of profit, right? But remember, this is not operating profit. This income primarily comes from interest earned on the money held in their trust account, which was about $26 million for this quarter. Their actual operating expenses, though, were around $513,000. So while they are technically profitable on paper, it's due to investment income, not from running a business. For the 9 months ending the 30th of September 2025, their net income was even higher at about $63 million. Again, this is overwhelmingly driven by interest earned on their trust account, which reached over $7.3 million. Their operating expenses for this longer period were around $12 million, so the story here is consistent. They are not generating revenue from operations. Instead, financial results are largely determined by how well the money in their trust account is earning interest. Looking at the changes in shareholders' equity, we can see the impact of these financial dynamics. The company sold private placement warrants, which brought in $750,000, and then we see a significant jump in the remeasurement of Class A ordinary shares due to redemption values. Changing this remeasurement is a technical accounting adjustment because these shares might be redeemed. They are not permanent equity in the same way as other shares. This remeasurement process shows up as a significant negative adjustment in equity, reflecting the potential liability these shares represent to the company. It is basically adjusting the value of these shares to what the company might have to pay out if they are redeemed. This is a critical accounting treatment for SPACs, and it influences how their equity looks on paper. By the 30th of September 2025, their total shareholders' equity was about $225,000. This may seem small compared to the assets, but it reflects the fact that a large portion of their capital Class A ordinary shares is classified as temporary and subject to redemption. Now for the cash flow statement, this is where we see the actual movement of money for the 9 months ending the 30th of September 2025. The company used about $948,000 in operating activities. This is essentially their burn rate for running the company before any business combination. The investing activities show a massive outflow of over $30 million. This is the money being invested into their trust account and the fin. Financing activities show proceeds from the IPO and private placements, indicating the inflow of capital. This $30 million investment into the trust account is the core of their strategy right now. They are deploying capital to generate returns while they search for their target. Let's dive into the notes, the real details behind the numbers. The company was formed on the 25th of July 2024, and it's been pretty busy since then. Their main goal is to find a target company, usually in cybersecurity, artificial intelligence, or financial technology. They had their initial public offering, or IPO, in December 2024, selling 20 million units for $10 each, raising $200 million. They also sold private placement warrants, raising another $7.3 million. This is common. They sell units to the public and then warrants to their sponsors and other parties to raise additional capital. And then in January 2025, they had a big moment. The underwriters exercised their over-allotment option, buying an additional 3 million units. This means they raised another $30 million from the IPO and an additional $750,000 from private placement warrants. This is a good sign. It means there was enough demand for their shares. And as a result, all this money went straight into the trust account. The money in the trust account is kept very safe. It's invested in short-term US government treasury obligations. This is to minimize risk and ensure the money is readily available when they need it for a business combination. There is a section about the sponsor's liability, which is important. They are on the hook for certain claims that could reduce the money in the trust account. This provides some comfort to investors that there are individuals backstopping some of the operational risks. There was a bit of a hiccup in August 2025. The company received a notice from Nasdaq, the stock exchange, because they had not filed their quarterly report on time. This is usually not a major issue if resolved quickly, and it appears they did file it by October, and Nasdaq confirmed they were back in compliance view. A key leadership change happened in October 2025 with the appointment of John J. Birmingham as the new Chief Financial Officer. This is always something to watch for, as new leadership can bring new strategies or challenges. Now let's talk about their cash situation. As of the 30th of September 2025, they had about $323,000 in cash outside the trust account. This might sound low, but for a SPAC getting ready for a business combination, it's not unusual. However, the report flags a pretty big concern. They state that these conditions raise substantial doubt about the company's ability to continue as a going concern. This is a serious statement indicating they might not have enough money to operate for a full year without raising more funds or completing their business combination. The company accounts for its investments in the trust account at fair value. Any changes in value, unrealized gains or losses are reported in their statement of operations. This is standard practice for investments. This is a crucial accounting policy. The class of shares that can be redeemed are classified outside of permanent equity. This means they are treated more like a liability than true ownership because of the redemption feature. The company recognizes changes in their redemption value immediately. This means that any increase in the potential redemption amount directly impacts their equity section and can be a drain on accumulated earnings or additional paid in capital. This table shows how the redemption value of those class of shares is calculated. It starts with the gross proceeds from the IPO and then subtracts allocations to warrants and issuance costs. Then it adjusts for the remeasurement to redemption value. This number is dynamic and shows the potential financial commitment these shares represent. This section details the IPO and the warrants. They sold over 23 million units in total, including the over-allotment option. Each unit came with one class of share, and half a warrant. Public warrants are those sold to the general public, while private placement warrants are sold to insiders like the sponsor. The company has the option to redeem their warrants under certain conditions if the stock price hits a certain level, or if they can offer a cash alternative. This is a way to clean up the capital structure after a business combination. Here we see the details of the private placements. Both the sponsor and B. Riley, the underwriter, purchased private placement warrants. These warrants have some restrictions on transferability and a slightly different exercise timeframe than public warrants. This is where we see the dealings with the sponsor. Roman DBDR Acquisition sponsored the second. LLC, the sponsor, initially bought founder shares for a nominal amount. They also provided loans for IPO expenses and are paid a monthly fee for administrative services. These related party transactions are common in SPACs and are intended to cover operating costs before a business combination. They pay $10,000 per month for office space and support services. This shows they are incurring regular operating expenses. This section explains how they value certain assets and liabilities. Fair value is how much something is worth on the open market. The company uses a hierarchy of inputs to determine this level. One is based on quoted prices in active markets. Level 2 uses other observable market data, and level 3 uses internal assumptions because observable data is limited. The over-allotment option is a tricky one. It's treated as a liability and valued using complex models like Black-Scholes. This is because it carries contingent value based on future events and market conditions. This table shows the inputs used to value that over-allotment option. Like interest rates expected volatility and the exercise price, it highlights the complexity in valuing these types of financial instruments. The management discussion section really reiterates what we've seen. The company has no operating revenues yet. All their financial activity is tied to IPO proceeds and investments. The going concern warning is prominent here. They acknowledge the need for more capital or a successful business combination to survive. They clearly state that their net income is from interest on the trust account, not from business operations. The period from July 2024 to September 2024 shows a net loss of around $90,000, which is primarily due to formation and operating costs. This is the real meat of the current situation as of the 30th of September 2025. They have $323,000 in cash, which is pretty low given their expected costs. The going concern doubt is mentioned again, backed by the fact that they need more funds or a deal. To continue operating, this really emphasizes the precariousness of their current financial position. Management highlights that their critical estimates mainly revolve around the valuation of that over. Allotment option liability, the stock volatility is a key factor here, and changes can significantly affect the reported numbers. Now let's cut through the noise and give you my take on Roman DBDR Accession Corp 2. The biggest story here is that this is a SPAC in its business combination phase. Its financials are dominated by the interest earned on the millions parked in its trust account, rather than any actual business activity. The going concern warning is a serious red flag indicating they are burning cash and need to find a merger partner quickly, otherwise they could run out of money. The company's future hinges entirely on its ability to execute a successful business combination. The redemption feature on the class. A shares also adds a layer of uncertainty, as a large portion of potential shareholder equity could be returned if a deal falls through the leadership changes, and the Nasdaq notice are minor points compared to the core challenge of finding and closing a deal. This is a high risk high reward situation typical of SPACs right now. The primary opportunity lies in management's ability to identify a strong target and secure shareholder approval. The weakness is their limited runway and the inherent uncertainties of the SPAC market. Alright, that is our deep dive into Roman DBDR Accession Corp IIS latest report. What are your thoughts on their strategy and these numbers? Do you think they will find a good business combination? Let us know in the comments below if you found this breakdown helpful. Give this video a thumbs up and subscribe for more corporate analysis, and don't forget to join our Discord community. For more in-depth discussions, we're here to help you decode the world of business one filing at a time. Thanks for watching. See you next time.